If you don't understand stocks, you don't understand wealth. Most people think wealth is about how much you have in cash. But look at this list of the richest men in the world. You can go all the way to the end. They're all rich from shares, not from money in their accounts. And if you don't understand stocks, you don't understand the real game of money. So in this video, you will understand. First, why stocks are the true language of wealth. Second, what is equity and what's the downside of equity. Third, how small amounts turn into fortunes through compounding. And finally, how this can change your financial life. This video was inspired by Keith D's super cool video. If you don't understand bonds, you don't understand money, I recommend you watch it too. Also, subscribe to the channel to receive more content like this. Let's dive in. So, first part, why stocks are the true language of wealth. The first real turning point in the history of shares wasn't in Amsterdam, but in America. John D. Rockefeller understood something most of his peers didn't. In the late 1800s, industrialists usually extracted profits as salaries or personal payouts. The company was a vehicle to enrich the owner in the short term. Rockefeller reversed that logic. He kept his salary modest and reinvested almost everything back into Standard Oil. And instead of demanding more cash, he accumulated shares. This wasn't just an accounting choice, it was a structural shift. A salary is labor income, linear, capped, and tied to hours or responsibilities. Shares are capital income. It scales with the growth of the enterprise, reinvests profits into more capacity, and compounds over time. The result was decisive. Standard Oil grew to control over 90% of U.S. refining, and Rockefeller's wealth came not from wages, but from dividends and the rising value of his shares. By the time he retired, his fortune, adjusted for today, was larger than that of any modern billionaire. Not because he earned more, but because he owned more. At the time, this model was unusual, even controversial. The idea of taking a symbolic salary and letting wealth accumulate through equity seemed counterintuitive. That same principle explains modern fortunes. Jeff Bezos's salary at Amazon stayed around $81,000 for years, irrelevant compared to his Amazon shares growth. Elon Musk takes no salary from Tesla. His compensation is tied entirely to stock performance. Steve Jobs, when he returned to Apple, famously accepted a $1 salary because the real wealth was in the shares. The pattern is consistent. The richest people in the world are not the highest earners of wages. They are the largest holders of equity. And that's not anecdotal. It's structural. Capital compounds. Labor doesn't. Wages are set by the market value of your time, your skills, and your bargaining power. Even at the top, doctors, lawyers, executives' salaries move within a range. Why? Because there's a ceiling to how much one person can produce in a fixed number of hours. Productivity per worker has limits. Capital isn't limited by time, it's limited by scalability. When you own equity, you own a slice of the productive capacity of an entire system. Machines, workers, technology, brand, distribution, network effects. These inputs can scale almost without limits. Take a surgeon. She might earn $500,000 a year, one of the highest salaries in the labor market. But to double that, she has to work impossible hours or raise her prices, and there's only so much patients or insurers will pay. That's the ceiling of labor. What you're looking at is the value versus labor curve, a visual representation of what happens when your income is tied only to effort. In the first years, from 1 to about 20, the red line climbs. That's your career growth. You get better at your job, maybe earn promotions, negotiate a raise, or switch companies for better pay. The value you generate increases steadily, and so does your income. But eventually, around year 20, the line stops climbing. It plateaus. Why? Because labor income has a natural ceiling. You run out of hours in the day. You hit the top of your pay grade. Your job stops scaling with your effort. Even if you're the best in your field, the value you create stays flat unless you own something that continues to grow beyond you. Now, take the founder of a medical device company. In the first year, maybe the company sells $2 million worth of machines. By year 5, if the device becomes standard in hospitals worldwide, sales could hit $200 million. Same owner, same 24 hours in the day. But because she owns, her wealth scales with the output of hundreds of employees and global demand. That's why billionaires aren't paid more, they own more. Equity allows wealth to escape the linearity of wages and tap into the exponential curve of capital growth. And from a macro perspective, this is exactly how wealth concentrates. Labor income grows slowly in line with inflation and productivity. Capital income compounds at a higher rate because businesses reinvest profits, expand markets, and benefit from technological progress. This is the logic Thomas Piketty famously summarized: R bigger than G. The return on capital is greater than the growth rate of the economy. So when you rely on a paycheck, you're stuck in the G. When you own equity, you participate in the R. Now moving to the second part. What is equity and why is it not as easy as people think? Let's start with a simple question. What if Zuckerberg had just taken 25% of Facebook's profits? He'd be rich, no doubt about it, but he wouldn't be Zuckerberg, because what made him one of the richest men on the planet wasn't the profit, it was the multiple. His wealth didn't grow with the cash the company made year after year. It grew with the value the market put on the company. And the reason he captured that value is simple. He didn't sell his shares. If Zuckerberg had said, just pay me a cut of the profits, he'd have made great income every year. But income caps your upside. Every dollar he took out as profit would have been a dollar less to reinvest in growth. Instead, by holding his ownership, those profits stayed inside the company. Facebook reinvested them into better ads, more users, new acquisitions like Instagram and WhatsApp. Each reinvestment made the company worth more. And since Zuckerberg still owned a massive stake, his net worth multiplied as the valuation multiplied. That's the difference. Profits grow in a straight line. Equity grows in jumps. You build in silence. And then one day the market wakes up and reprices everything. That's why Zuckerberg's net worth curve explodes while Facebook's profit curve looks small next to it. Because he didn't just take money out, he held ownership. And ownership is what made him Zuckerberg. That's what equity does. It turns 20 years of effort into 1 minute of value. So let's get clear. Equity is ownership, real legal ownership. When you buy one share of Apple, you're buying a slice of the most profitable tech machine on earth. You own part of the brand, the patents, the stores, the cash flow, and that comes with rights to profits, to votes, to decisions. That's why equity isn't just a financial asset. It's the bridge between capital and production. And it's also why every major boom in history showed up first in the stock market. Railroads, oil, internet, AI. The pattern is always the same. New technology arrives, companies issue shares, and the people who get in early own the upside. But here's the part no one likes to talk about. Equity is also brutal. You're not first in line, you're last. When a company goes down, here's the order. Creditors get paid. Employees get severance. The government takes its taxes. And shareholders, they get nothing. That's the trade. Unlimited upside, but no safety net. And when macro pressure hits, like rising interest rates, inflation eats into input costs, recession slows demand, competition destroys pricing power. That's why tech stocks fall first when the Fed raises rates. They're priced on the future, and the future gets discounted. And let's be real, that's also why bubbles happen. People confuse equity with hype. They think buying any stock will make them rich, but markets run on emotion. In the 1840s, British railway stocks boomed. Most went bankrupt. In 2000, the dot-com wave came. Amazon made it. Pets.com didn't. Same in crypto, same in AI. Always the same cycle, because equity magnifies everything. If you own the right business, it compounds your life. If you own the wrong one, it compounds your mistakes. So don't just ask, what stock should should I buy? Ask instead, do I understand this business? Is it building real value or just selling hype? Am I buying something solid or just joining a crowd? Because the stock market isn't a scoreboard. It's a sorting machine. It separates the builders from the talkers, the real value from the noise. And if you don't know what you're holding, the market will eventually show you. Now, let's move into the third part. How small amounts turn into fortunes through compounding. You probably already know this part because every finance YouTuber has already talked about it, but looking at it from an economic and market perspective. Compounding is where equity goes from being powerful to being transformational. It's the quiet force that explains why the richest people in the world don't just own equity, they hold it for decades. Think of compounding as money that works like a snowball. You start small, it rolls down the hill, and over time, it picks up more snow, not just from the outside, but also from what it already accumulated. Equity is the same. Companies reinvest profits into new factories, more research, better products, bigger distribution. Each reinvestment creates more profit, which creates more reinvestment, which creates more profit. The loop accelerates over time. Let's put numbers on it. Imagine you invest $10,000 in an index fund that grows at 10% per year. After the first year, you've got $11,000. Nothing impressive after 10 years that grows to around $26,000. Still modest, but push it to 20 years, it's about $67,000. By year 30, it's $174,000. And if you leave it for 50 years, it becomes more than $1,147,000 from the same $10,000 seed. The difference isn't the math changing, it's time. The longer the system compounds, the more it accelerates. That's why Warren Buffett is the perfect example. He started investing as a kid, and by the time he was 30, his wealth was already close to $1 million. At 50, it had grown to nearly $300 million. But the real explosion happened after 60. More than 90% of his current net worth, well over $100 billion, came after retirement age. Not because he suddenly got smarter, but because compounding had decades to work at full speed. And finally, how does this change your financial life? If you watch this video until the end, you now understand something most people never will. Wealth is not about how much you earn. It's about what you own. Your job pays your bills, your equity builds your future, and that understanding alone, it changes your decisions starting today. Here's how to apply everything we just covered. Step 1, stop chasing higher salary, start building capital. Yes, work hard. Yes, negotiate your pay. But don't fall into the trap of thinking more hours, worse, more wealth. That mindset plateaus. Every time you earn money, ask, how much of this can I convert into equity? That could be investing in stocks, buying into a business, taking a stake in your own company. Step 2, don't just save, buy ownership. If you're just stacking cash, inflation is quietly stealing it. If you're only saving in a fixed income account, your money is barely crawling. But if you invest in equity, even just index funds, you're buying a slice of scalable value. Start small, 100 month into an ETF that tracks the S&P 500. Automate it, make it non-negotiable. Step 3, think like a founder. Even if you're not one, founders don't sell their time. They build something that grows without them. Even if you're not building a startup, you can adopt that mindset. Ask yourself, how can I create something once that keeps generating income after I stop? That could be a course, a product, a digital asset, or even just content that builds brand equity. Step 4, play the long game. You saw that one of the reasons that can hinder the accumulation of wealth is not playing the long-term game, selling too early. Also, remember the Buffett rule. Compound interest only works if you give it time. So give it time. Let your equity breathe. Step 5, rewire your identity. You're no longer just a worker. From today forward, see yourself as a capital allocator. You earn, you save, you invest, and you build. You're not chasing a raise, you're accumulating productive assets. Every dollar you earn is now fuel for your equity engine. And that's how this video can change your financial life. Because now you don't just understand money, you understand wealth.